All righty. Welcome everyone to today's Sunday macro wrap up for Sunday, June 8th. How's everyone doing? Awesome, awesome. Yep, we got people on the Zoom call here from our macro investing community. And so, for those who are joining on the live stream, typically the way that these Sunday macro wrap ups work is that during the first 30 minutes, we'll go over everything looking at last week as well as what we're looking at going into this week. And then the last 30 minutes, that'll actually be offline, only reserved for our macro members. And so if you guys would like to become a member, you can start a 7-day free trial of our macro investing community by going in the description below for those who are on YouTube. And for those who are on our socials, you can join us through the link in the bio there. So let's go ahead and get going here with Treasury yields. So there's a lot of discussion and debate on the still the high Treasury securities, right? The yields are still remaining pretty much the levels that they were back in 2022 when inflation was running around 9%, right? And so since then, inflation is closer to the Fed's 2% target. But what gives? Why are yields still remaining high like this? Well, part of the reason, really the main reason is that the Fed is concerned that inflation is not transitory and that it could reaccelerate if they start cutting from here. That as well is that nothing has signaled that the market is distressed as far as the financial markets go, that they would need to cut anyways, right? So when we take a look at things like credit spreads, they remain relatively narrow, even though they did widen a little bit during the tariff tantrum that we saw, a month or so ago. And so if the market is signaling that there's no real banking stress, as well as the Fed is concerned that inflation could reaccelerate, well, then why would they cut rates? And so that's what is happening. And a lot of people, especially those who are relatively new to markets, right? Really, they got started, anywhere between 2008 and 2020, and they got used to low inflation as well as low interest rates. Well, that era was really the exception because when you take a look at all of from when the Fed was created back in 1913, you can see that interest rates remain relatively higher, right? The majority of the time, they're anywhere between 5 to 8% is really the historical normal rate. And so when looking at where rates are right now, it shouldn't be surprising. This is actually the historical norm. And again, if the market can take these rates without anything breaking and the Fed is concerned about inflation, they might not cut for the rest of the year. And don't just take my word for it, right? If we look at this at the futures market, the target rate probabilities for the Fed meeting on June 18th, when is that, next week? Yeah, next Wednesday. That's basically at 100% chance that they're going to remain paused. Where, just a couple months ago, I think it was like a 70% chance that they were going to cut. Now, if we go all the way out to the September meeting, that's when there's more of a pricing in of a 25 basis point rate cut, but it's still pretty close. And when you take a look at where staying paused was at just 1 month ago, this was at nearly 11%, and now it's nearly 40%. Right. And so, the futures market was pricing in around 6 cuts about 4 months ago, and now that has been reduced to just 2 cuts in 2025. And so we are stuck in this no landing scenario, meaning that, we're not in a hard landing recession, but we're also not in a soft landing. It's going to remain in this choppiness where we go into that doom loop that we've talked about before in previous videos. where, the market, the S&P 500 goes up, inflation expectations goes up, the Fed keeps rates higher for longer. Then because of that, we start to get, inflation or growth to come down. And then, stocks come down a little bit, inflation starts to come down, and then the Fed gets more dovish, and then the whole cycle repeats again. That's pretty much what's been playing out since 2023. And in that environment, you've had a stair-step ladder of the S&P 500 going higher and that type of no landing, doom loop. And so there's no reason to believe that in this, if we maintain here, especially with the amount of fiscal spending that's been going on, right? Because when we take a look at this current administration on the fiscal side of things, they're essentially doing the exact same thing as the Biden administration, right? So Janet Yellen, Biden's Treasury Secretary, she was issuing treasuries at the short end of the curve. Well, Scott Bessent is doing the same exact thing right now, which is strange because he was critical of Janet Yellen for doing that, yet he's doing the exact same thing. And so this is deficits continue to be blown out in quote unquote peacetime, meaning that the United States isn't involved directly in a hot war. This is the highest, deficit spending that's going on in history right now. 6 to 7% of GDP. That's unheard of. Typically, it's around 2 to 3%, right? So it's nearly double from what it normally is. And so, yeah, that's going to keep rates higher. And so, getting into some of the different data that we saw last week, taking a look at the dashboard that I have here on mrktedge.ai. This is a little bit of a newer website that I've been using that I like. Definitely check them out. But they have this really convenient economic calendar where they have some of the things that I like better. So instead of just using Forex Factory, MRKT gives a little bit more nuance, as well as it has some nice AI predictions on what the number is going to be. But taking a look at last week's numbers, right, we saw the ISM manufacturing as well as services PMI continue to go down together. Now, taking a look at a chart of this, going all the way back to the pandemic, we can see that since the pandemic, there's only been 3 other times where both the services PMI in blue as well as the manufacturing PMI in orange have both been in contraction territory, meaning that they are below 50. And typically this hasn't lasted more than 1 month, going from the pandemic, right? And so what we've seen ever since the peak back in November of 2025 or October, services in blue has continued to have a stair step down lower. And this is more of a distinct trend than what we saw beforehand, where you saw, a flash crash in 1 month and then a pretty quick rebound. And so from here, if we continue to see both services as well as manufacturing remain in contraction, right? So below 50 for more than one consecutive month, that will be something new that we have not seen since the pandemic. And I wouldn't be surprised if we do see that, because growth is slowing. A lot of the leading indicators that we've been getting is indicating that growth is decelerating, because having rates at these higher prices or at these higher rates isn't just free money that you can collect in a money market account, which I hope you're doing. Take advantage of that. Not financial advice, but don't just let cash sit. If you let cash sit in a checking account, collecting like the 0.01% that like Chase or Wells Fargo gives, man, you are just missing out, and you're not out competing inflation, which is the whole purpose of investing in the first place, is to preserve your purchasing power against inflation. So anyways, as growth continues to decelerate, this will eventually start to be a hindrance on inflation. But you have to remember, we have two types of inflation, and two places where you can see it show up, right? So we have supply side and demand side inflation. COVID caused a lot of supply side inflation, and since supply chains have normalized, we're getting a lot of the inflation, from demand, right? And then we're seeing a lot of increase in prices from suppliers, right? So producers, not so much on the consumption side. And so this is eating into margin with a lot of these larger companies. And so that's why you've seen over the past couple weeks here, there's been a lot of guidance, downward guidance in a lot of companies that were signaling earnings. I mean, just look at something like Lululemon, right? They guided down tremendously. And so when we take a look at this, different retailers like Lululemon are all signaling that this year is going to be tough. And and yeah, when we see and it's not just Lululemon, there's others too. You can look it up yourself. But this is a trend that we're seeing now in 2025 because growth is really starting to struggle right now, and people are choosing to just, not spend as much, and we're going to continue seeing that, right? So, prices could be staying flat or coming down, but for producers, costs are remaining sticky. All right, let's go on to let's see. We took a look at, okay, yeah. So last week we also received jobs numbers. So remember, the first week of the month is always talking about the jobs report. And so we had some mixed data, right? So, like the ADP jobs report, that actually was one of the worst prints that the ADP saw in a while, right? This was the lowest since March of 2023. But conversely, we saw that average hourly earnings remain steady, even though it still has been decelerating year over year for quite some time, as well as average weekly earnings has actually been accelerating since it bottomed back in January of 2024. And then we also had non-farm payrolls remain relatively elevated. So if we go all the way down here, we can go to non-farm payrolls. This went to 139,000 jobs when the forecast was 130K. Now it's still a deceleration from the previous month, but it wasn't as bad. And so the unemployment rate remained steady, and it just wasn't as bad as what people thought, right? And so, with that being interpreted as not as bad as people thought, it was a little bit more of a positive note, saying that, hey, even though growth is decelerating, even though there's, some fears, at least the labor market is holding up for now. Now, you have to remember that the labor market jobs data is incredibly lagging. And it's one of the last indicators that suggests that we're in a recession. So, if you're just banking on jobs numbers, then it's typically a backward looking indicator and not something that would, help predict anything, right? It's more of a confirmation lag. Some people use it as a leading indicator for the next upswing of the next, super cycle bull market. Now, so yeah, there was mixed data, still a slowdown in the jobs number, right? But what was interesting is that we finally saw total construction spending in the United States go negative year over year for the first time since April of 2019. And I know that a lot of people have been seeing a lot of negative data from the housing market, which is true. But construction spending, supplies coming online, people are not buying, and we're now starting to see a nationwide decline in prices. And in hot spots like in Florida and Texas, you're seeing large drops in prices. And I would not be surprised if that trend continues. And a lot of these developers continue to compete with um, uh, you know uh, real estate investors on lowering their prices, right? Because these developers and investment sellers compete against each other in a seller or in a buyer's market. And so I wouldn't be surprised if that continues, that trend in 2025, where the housing market continues to crack. Um, and so, yeah, that's another uh, interesting indicator that we saw last week. And then lastly, looking at the challenger job cuts, we saw one of the highest accelerations in layoffs in the services industry that we've seen in quite some time. So, taking a look at the services sector, they announced 22.5 thousand job cuts in May. Now, this is the highest monthly total since the depths, the trenches of the COVID era layoffs, and that's up 79% from this time last year. So, and again, we talk about this a lot on this channel, but services make up the majority of consumption than goods, right? Because the United States is more of a service-based economy and not so much, manufacturing goods, although there is that part, right? But it was amazing to see for the first time since May of 2020, a lot of the announced layoffs were coming from the services sector. And again, this is not something that we've seen yet. This is all signaling, by the way, that we're in more of a late stage time period in this cycle. So I wouldn't be surprised if this continues. All right, now looking on to this week, the second week of every month is always dealing with inflation numbers, right? So we're heading into the second week here. We have headline inflation at 2.3%. We have core inflation at 2.8%. And the expectation is that these numbers are going to remain sticky or even reaccelerate. And don't just take my word for it, right? Looking at the Cleveland Fed, they're showing that the May number is going to accelerate to 2.4%, and that core CPI is going to accelerate to 2.8%. And then the June number, so the month or the reporting numbers after that, are going to go from 2.4 to 2.7 and from 2.8 to 3.0. So back to 3.0, right? So that would be similar to February of 2025 for core. And then going back to 2.6, that'd be similar to, October of 2024. So the Cleveland Fed inflation nowcast is signaling that inflation, could pick up from here. And it's not just because of tariffs, but it's also because of you have things like oil reaccelerating and bottoming, right? So if we take a look at a price of oil here, just scroll down. So look at the price of oil. All right. So we're heading into the second half of the year, and this has been accelerating from its bottom all the way back on April 9th. And when taking a look at what the price of oil did at the second half of last year from July till December, went down about 17%, almost 18%, which means that the comparison or the comp for the second half of this year compared to last year is easier, meaning that if there was going to be a year over year deceleration, then you would need to see oil completely collapse from here, which if that's the case, that might be signaling a global recession. And so that's why a lot of leading indicators are suggesting that inflation is going to remain sticky from here or even accelerate. And that's what the Fed is also concerned about, is that inflation component reaccelerating. All right, because if we take a look, let's bring up an indicator here. Let's go to the rate of change. And we're on the daily, so we got to change this to 252 trading days. All right. So so look what the rate of change is doing, right? It's accelerating from here. See that? Even though it remains negative, it is less negative than it was when it bottomed on April 9th of last year, or of this year, rather. And so seeing how the rate of change, the year-over-year rate of change had a large deceleration from mid-June all the way to September, it wouldn't be surprising if the rate of change of oil continues to accelerate from here, right? And so that's what you have to look at. All right, beat that dead horse. Inflation is going to remain sticky. But again, you don't have to take my word for it. Look at what the Cleveland Fed is saying. Look what oil is doing. Look what bond yields are doing, which we already covered. These are all signals that inflation is going to remain sticky. And the reason why I keep harping on this again is also because I keep having people in the comment sections of my videos saying, "What are you talking about? Inflation is reaccelerating. It's almost down to 2%." It's like, yeah, okay, but when you're looking at PCE and you're looking at CPI, those numbers are incredibly lagging. And if you're looking at inflation numbers from 2 months ago, then you're going to be left behind. All right, so try and look at leading indicators so that you are being prepared for what's actually being priced into the market. Now, the yield curve, what's interesting is that it's been doing a bear flattening. And so, the title of this video is, the snow landing scenario, what's going to get us out of this? And really, there's only 3 different scenarios that could happen from here. Right? So number 1 is that growth keeps slowing, causing inflation to then slow, but then that reignites recession fears. So that's obviously not great for equities. Number 2, growth starts improving from here, which would be a complete 180 from what it's been doing. We would need to see a really large acceleration in the rate of change of growth from here, which, I mean, it could happen, right? Anything can happen. But again, that would be a complete 180 from what's happening. So if that happens, then you're still not getting any rate cuts, because that would mean that if growth is accelerating and inflation is remaining sticky, then you would see a re-steepening of the yield curve, which would mean rates would still remain where they're at right now, which is around 4.5%. So even if things start improving, rates are not going to come down. And then the third scenario is that something breaks. Right? So 2 out of the 3 options, or there's a 66% chance that in the medium to longer term, right, between, in the next 3 to 18 months, which I know is a long time spread, but it's impossible to predict these things. But, 2 out of the 3 options results in that medium to long-term headwind for equity markets. And I'm not trying to predict what happens in the short run because that's impossible to do. But just seeing from where we're at, this fiscal dominance that's happening right now, where the government just keeps on printing money and issuing treasury securities at the short end, that is unsustainable. So, yeah, the medium to long term is definitely not looking too great, but in the meantime, we're still going to be continuing to have longs in the things that are doing well, right? So, namely, what was the best performing asset last week? Silver. Another one that's emerging is copper. Not as much, but yeah, silver was one of the best ones. Gold has been remaining bullish, but it, is losing some trend strength. But this is all happening as equity markets and growth continues to reaccelerate, right? I mean, just look at Bitcoin, just look at the S&P 500. Now, at some point, this rally in the S&P 500, at some point, this is going to have a correction because, this bounce just can't keep on. At some point, even if you're, just someone who just buys dips and never even sells, at some point, this is going to provide an opportunity at a lower price. And I'm not sure if we're going to be getting that this week. We could, right? Anything can happen, especially in this era where, the richest man in the world and the most powerful man in the world are having a Twitter battle. But I swear this timeline is crazy. We live in a simulation. But yeah, at some point this is going to correct and we'll see what happens from here. And so, yeah, with that, what we'll do is we'll go ahead and take this offline for the people who are on the Zoom call here in our macro investing community. And so, for those who are joining us live on YouTube, X, Instagram, as well as TikTok, if you'd like to if you'd like to join the rest of the discussion so that you can have some good ideas heading into this week, you can go to the link in the description below or the link in my bio to start your 7-day free trial in our macro investing community so that you can stay ahead of these macro trend shifts. And so I appreciate everyone for joining. Those who are on the Zoom call, stick around. We're going to go ahead and wave bye to people on social media, and we'll catch you next week on next week's Sunday macro wrap up. Good luck out there, and we'll catch you then. Bye.